Artificial intelligence has become the most exciting and volatile technology story of the 21st century, captivating the imagination of investors, corporations, governments, and everyday people across the globe. Every day brings headlines announcing breakthrough models, autonomous systems, unprecedented valuations, and companies racing to dominate what many believe will be the most transformative technology in human history. The numbers tell a story of unprecedented enthusiasm. In 2025 alone, global AI infrastructure investment approached $400 billion annually, with projections suggesting annual spending could reach $500 billion by 2026 and exceed $3 trillion cumulatively by 2029. Investors, corporations, and governments have poured over $250 billion into AI startups in 2025 alone, representing more than 60% of all venture capital funding worldwide. This concentration of capital is staggering, reflecting a collective belief that artificial intelligence will reshape every industry from healthcare and education to manufacturing, finance, and national security. Technology companies associated with AI have seen their market values surge to historic proportions, creating fortunes almost overnight and making artificial intelligence one of the most valuable sectors in global markets. Yet beneath the surface of this extraordinary enthusiasm lies a troubling reality that few investors pause long enough to confront. The companies driving this technological revolution are not actually profitable. OpenAI, the organization that sparked this entire boom when it released ChatGPT in November 2022, is projecting operating losses that will reach $74 billion in 2028 alone. That figure represents nearly 75% of the company's projected revenue for that year. The company expects to burn cash continuously through 2029 before potentially achieving profitability by 2030. Internal financial documents reveal that OpenAI spent more than $20 billion on operating losses in 2025, while generating $13.1 billion in revenue, creating a burn rate where losses exceeded revenue by 158%. For every dollar of revenue the company generates, it is spending substantially more than $1 on compute infrastructure, research, and operational expenses. The company is committed to spending $1.4 trillion on computing deals with Microsoft, NVIDIA, Oracle, and other infrastructure partners over the next 8 years, a staggering number that requires extraordinary revenue growth and eventual profitability to justify. Even competitors are struggling with similar dynamics. Anthropic, which many analysts consider the second most valuable AI startup, burned through $5.6 billion in 2024 and $3 billion in 2025, though the company's financial trajectory appears more controlled than OpenAI's aggressive expansion strategy. Yet even Anthropic's path assumes it can reach profitability by 2028 or 2029, requiring massive revenue scaling with simultaneously controlled spending. These profitability challenges represent the most fundamental problem underlying the current artificial intelligence bubble. Across the entire sector, from the largest foundation model developers to the startups building on top of their APIs, virtually every company is unprofitable. The economics are brutal. Global AI infrastructure spending in 2025 was estimated between $260 billion and $400 billion. Yet total AI industry revenue was estimated at less than $50 billion. This means the sector is spending $5 to $8 on infrastructure for every dollar of revenue it generates. The inference costs of running these models continue to increase despite years of promises that costs would decline. ChatGPT increasingly costs OpenAI millions of dollars daily to operate, with new video generation capabilities like Sora reportedly costing millions per day just to develop and test. The massive companies backing AI are also losing money on their AI infrastructure services. Oracle announced a $300 billion deal with OpenAI to provide computing power. Yet recent reports suggest Oracle expects to lose considerable sums on these rental arrangements, having already accumulated $100 million in losses in a recent quarter. This creates a circular dynamic where companies like Microsoft, Amazon, and Google are investing hundreds of billions in data center build-outs and AI infrastructure, losing money on those operations while hoping to eventually recoup investments through software and services that run on top. The infrastructure spending is so enormous that AI-related capital expenditures now account for more than half of total capital spending growth in the United States economy. Consider the specific economics facing OpenAI as it represents the purest play on the AI boom that is transforming markets. The company projects it will need to spend $121 billion on computing infrastructure alone in 2028, a number that dwarfs its projected revenues and would require extraordinary efficiency gains and pricing power to ever become profitable. OpenAI's strategy appears to be one of dominance through scale, spending aggressively to build the most powerful models and assuming that market leadership combined with eventual efficiency improvements will create a path to profitability. But this strategy carries existential risk. If cheaper, more efficient models emerge that satisfy customer needs, OpenAI's massive spending advantage becomes irrelevant. If regulation restricts how these models can be monetized, the company's path to profitability evaporates. If competing foundation models reach parity with OpenAI's systems while consuming a fraction of the compute resources, OpenAI's entire investment thesis collapses. This scenario has become less theoretical and more concrete with the emergence of DeepSeek, a Chinese AI startup that released models in early 2025 that matched or exceeded OpenAI's capabilities while reportedly using a fraction of the training compute. DeepSeek's efficiency demonstrated that market leadership was not necessarily tied to spending the most money, but rather to engineering excellence and innovation. A single Chinese startup with different capital structures, lower cost structures, and fewer regulatory constraints proved that the assumption underlying trillions of dollars in infrastructure spending might be fundamentally wrong. The emergence of DeepSeek in 2025 sent shockwaves through markets that reveal the fragility of current valuations. When the Chinese startup released its R1 reasoning model, demonstrating capabilities comparable to OpenAI's O1 model while operating at a fraction of the cost, NVIDIA's market capitalization collapsed by $588 billion in a single day, the largest single-day loss for any stock in history. The fact that the market could lose nearly $600 billion of value in one trading session reveals the precariousness of valuations built on assumptions of American technological dominance and infrastructure spending justification. If one startup's release could wipe hundreds of billions from market value, the underlying valuations were never based on fundamental economics. They were based on sentiment, momentum, fear of missing out, and consensus belief that AI dominance would persist indefinitely. DeepSeek also demonstrated that expensive American chips were not necessary to develop world-class AI systems. The startup reportedly acquired and strategically deployed older generation NVIDIA chips stockpiled before American export restrictions took effect, proving that circumventing export controls was possible and that alternative pathways to AI development existed beyond the controlled ecosystem American policymakers hoped to maintain. Chinese firms have rapidly deployed open source models that are freely downloadable, gaining market share globally through cost effectiveness rather than performance advantages. These developments threaten the assumption that American companies could command premium prices for AI capabilities indefinitely. The valuation multiples being paid for AI companies represent another dimension of bubble economics. OpenAI was valued at $730 billion in a February 2026 funding round, an increase from $300 billion just 9 months earlier, despite the company showing no clear path to profitability and facing intense new competition. Anthropic reached $965 billion valuations in private markets, valuing a company founded in 2021 at nearly $1 trillion before it has even achieved profitability. These valuations rest on assumptions about future markets that may never materialize. Databricks, a data engineering platform, raised funding at $134 billion valuations after its CEO called it peak AI bubble just months earlier at lower valuations. The willingness to pay exponentially higher valuations for the same company despite no change in fundamentals reflects pure sentiment-driven speculation. Stock market valuations are similarly stretched. The 7 largest technology companies trade at approximately 28 times forward earnings, down from peaks during the dot-com bubble, but still elevated compared to historical norms. However, these companies are accounting for nearly 1/3 of total S&P 500 market capitalization and more than 90% of stock market gains over recent years. As of late 2025, the 5 largest companies held 30% of the S&P 500 and 20% of global equity indexes, the greatest concentration in half a century. This concentration is historically reminiscent of the railroad bubble of the 1800s when a single sector consumed investor imagination and capital. The forward price to earnings ratio for American technology stocks sits at approximately 29.7 times, well below the peak of 55 times during the dot-com era. Yet recent history suggests this comparison is misleading. The dot-com bubble was driven by companies with minimal revenues and massive expected futures that never materialized. Today's bubble is driven by companies with real revenues that are unprofitable and companies with merely aspirational paths to profitability under aggressive assumptions about future dominance. The psychological forces driving this boom deserve careful examination because understanding investor behavior may be more important than analyzing financial statements when predicting when the bubble will burst. Fear of missing out, or FOMO, has emerged as perhaps the dominant psychological force in markets. Investors watch news coverage of AI breakthroughs, read stories of early investors making fortunes, and observe the consistent upward march of AI-related stock prices. Social media amplifies this psychology exponentially. LinkedIn articles celebrating AI stock gains reach millions. CNBC dedicates entire segments to AI valuations and opportunities. Financial advisors feel pressure to position client portfolios toward AI despite concerns about valuations. Retail investors with limited investment experience see AI as a no-lose proposition, particularly after markets recovered from the 2022 decline and reached new highs dominated by AI names. The combination of positive sentiment, media coverage, peer effects, and technical momentum creates a powerful psychological loop where rising prices attract more participants who believe they are identifying the next great thing. This was the same psychology that drove the dot-com bubble, the railroad mania of the 1840s, and virtually every speculative episode in financial history. What makes today's situation particularly dangerous is that knowledge of the bubble does not prevent participation in it. Investors, executives, and even AI company founders openly acknowledge that valuations appear excessive and that the sector exhibits bubble characteristics. Billionaire investor Ray Dalio stated that AI is now in the early stages of a bubble, noting that his bubble indicators sit near levels last seen in 2000 and 1929. Michael Burry, the investor famous for betting against the housing bubble before 2008, has taken short positions against Nvidia and Palantir, warning that the AI bubble will unravel and create a difficult environment for equity investors. OpenAI CEO Sam Altman acknowledged in 2024 that the industry is overexcited about AI prospects. These warnings have had minimal impact on valuations. The most transparent bubble in history, observed in real time by sophisticated investors who issue public warnings, continues to expand. Why? Because acknowledging a bubble does not solve the fundamental problem that investors face. Sitting on the sidelines means missing gains if the bubble continues to inflate. Participating in the bubble means potentially suffering devastating losses when reality finally clashes with expectations. The hedge fund manager faces a dilemma: maintain a defensive posture and significantly underperform the market, or participate in suspected bubble dynamics and hope to exit before the crash. Many choose participation, betting that they can time the exit, or assuming that their analytical superiority will allow them to identify when sentiment shifts before other market participants do. The path of bubbles through history shows a consistent pattern, despite investors' knowledge that they are in speculative episodes. Railway mania lasted approximately 4 years from acceleration to crash, from 1843 to 1847. The dot-com bubble's acute phase ran about 5 years, from 1995 to 2000, though the Nasdaq took 15 years to return to its peak. The housing bubble lasted nearly a decade before collapsing. Patterns suggest that major technology bubbles take 4 to 6 years from mainstream awareness to collapse. ChatGPT reached mainstream awareness in November 2022, which would suggest the AI bubble could sustain itself through 2026 or 2027 before beginning to deflate. Some analysts suggest we are currently in the second or third year of the typical bubble progression, meaning the most dramatic upside and eventual crash may still lie ahead. If this pattern holds, valuations could expand further before contracting, making short positions potentially premature and continuing to punish investors who have adopted cautious positioning too early. The pattern also suggests that capital intensity does not prevent bubbles from forming or extending. Railway bubbles involved massive infrastructure spending, yet still collapsed. The dot-com bubble involved substantial fiber optic cable deployment, yet still ended in crash. The housing bubble involved trillions in residential construction, yet still ended catastrophically. Infrastructure spending creates jobs, economic activity, and genuine asset value, even if the investment thesis underlying the speculation proves wrong. This is why the argument that the AI bubble is less dangerous because it involves real infrastructure spending is misguided. Real infrastructure spending does not prevent bubbles. It merely ensures that when bubbles burst, the wreckage includes genuinely useful assets alongside malinvestment. Competition, efficiency improvements, and the possibility of commoditization represent grave threats to the bubble thesis. If AI becomes a commodity service with declining prices, the economics that underlie billion-dollar valuations collapse instantly. Google has openly acknowledged that it struggles to monetize AI despite integrating it into search and building significant capability. Microsoft has spent billions partnering with OpenAI, yet faces questions about how to extract sufficient value to justify its investments. Amazon's partnership with Anthropic faces similar questions. If demand for AI capabilities is lower than currently assumed, all the infrastructure spending becomes stranded investment. If pricing power proves weaker than expected, companies cannot recoup costs. If Chinese companies dominate open source and cost-efficient implementations, American companies will struggle to generate the returns on invested capital required by public markets. These are not speculative concerns, but rather questions actively being debated by sophisticated market observers. The fact that these concerns have not yet shifted market sentiment reflects psychology overpowering fundamentals, a defining characteristic of speculative bubbles. Regulatory risks have also begun surfacing. The European Union implemented comprehensive AI regulation. The American government has debated AI policy without achieving consensus. China is developing its own regulatory framework for AI and is not bound by restrictions that apply to American companies. If regulation restricts how AI companies can monetize their systems, or restricts deployment of AI in critical sectors, or imposes taxes on AI infrastructure, the path to profitability becomes exponentially more challenging. National security concerns are rising. There is discussion of restricting AI chip exports to potential adversaries, limiting cloud computing access to foreign entities, and controlling frontier AI model development. These discussions suggest that geopolitical concerns might override economic considerations in determining AI policy. If governments decide AI represents sufficient national security risk to restrict development and deployment, the scale of the opportunity shrinks dramatically. The most troubling aspect of the current bubble may not be the valuations themselves, but rather the circular financing structures that have emerged to support them. NVIDIA, which is valued at over $4 trillion, committed $100 billion to invest in OpenAI, a company that is the largest customer for NVIDIA's chips. Microsoft, the largest shareholder of OpenAI, purchases cloud computing services from NVIDIA. Amazon is the largest investor in Anthropic, while also purchasing massive quantities of NVIDIA chips to power its AWS data centers. Oracle announced a $300 billion deal with OpenAI to provide computing infrastructure. These circular arrangements, where the same capital flows between ecosystem participants multiple times, with each transaction creating the appearance of market validation, are reminiscent of the circular financing that characterized internet bubble infrastructure investments. When the same group of mega-cap companies is simultaneously investing billions in each other's valuations while buying each other's products, the circular nature of the arrangement becomes self-evident. Breaking any single link in the chain could cause valuations across the entire ecosystem to collapse as the source of apparent market validation disappears. The human cost of this bubble extends beyond those who suffer investment losses. Brilliant researchers who might otherwise tackle fundamental scientific problems have been drawn to AI by enormous compensation packages and the prospect of enormous valuations. Venture capital that might fund other transformative technologies has been concentrated in AI. Regulatory attention and political focus have been dominated by AI concerns. The opportunity cost of the malinvestment will eventually be measured in decades of delayed progress on other important problems. Additionally, the bubble's existence has created perverse incentives throughout the ecosystem. Companies add AI to their descriptions and presentations to attract capital. Universities launch AI programs to attract students and research funding. Consultants claim expertise in AI monetization. This dynamic produces massive amounts of low-quality activity that does not generate genuine economic value. When the bubble deflates, billions in capital that created no real value will simply disappear, leaving investors devastated and an economy diminished. The timing of the inevitable crash remains unknowable, but the pattern is clear. Valuation multiples at elevated levels, profitability timelines stretching into the distant future, new competition proving existing assumptions wrong, regulatory risks mounting, circular financing. relationships creating fragility, and sophisticated investors openly warning that bubbles exist, combined with continued irrational enthusiasm driving prices higher. This is the classic setup for a significant correction. When the crash comes, it will likely be triggered not by a single event, but by a confluence of disappointments. AI companies will miss revenue targets as demand disappoints or prices decline under competitive pressure. Infrastructure spending will be revealed as excessive relative to actual demand. Margin pressures will mount as competition intensifies. Regulatory restrictions will limit monetization. At that point, the collective agreement that these companies deserve trillions in valuation will end abruptly, as collective agreements always do during crashes. Stock prices will decline, not gradually over months, but violently and suddenly as investors rush toward exits simultaneously. Hedge funds and passive index funds holding concentrated positions will face redemptions they cannot meet. Valuations will collapse, not just for obvious overvalued startups, but for the entire AI ecosystem, including the supposedly fundamental infrastructure companies. The losses will be measured in tens of trillions of dollars of market value destruction. Yet the ultimate outcome is paradoxical. The crash, when it comes, will not mean that artificial intelligence fails or that the technology is not transformative. The internet remained transformative and genuinely revolutionized human civilization, despite the dot-com bubble crash destroying 90% of NASDAQ value. Railroads genuinely transformed transportation and commerce, despite the railway mania crashes destroying investor fortunes. The technology itself survives and eventually thrives, even when investment expectations have become wildly detached from reality. This is why distinguishing between transformative technology and transformative investments is critical. Artificial intelligence will likely change the world. It will likely increase productivity, enable new applications, and generate genuine economic value. Some companies will build important AI systems and generate extraordinary profits. But the investment case does not rest on whether AI is transformative. It rests on whether current valuations are justified by reasonable expectations of future profitability, on whether competitive dynamics will allow these particular companies to capture value, and on whether regulatory and geopolitical constraints will limit growth. These are questions where current market prices suggest answers that become increasingly difficult to defend as one examines actual economics. The wisest approach for investors is to recognize that distinguishing between the technology and the investment is essential. Believing in AI's transformative power does not require believing in current valuations. Understanding that bubbles are visible in real time does not prevent them from expanding further, but it can inform position sizing and risk management. Acknowledging that concentrated portfolios, circular financing relationships, profitability assumptions, extending years into the future, and competitive threats from unexpected sources represent genuine risks is essential. The AI bubble may continue to expand for months or years, but the economic fundamentals that typically support sustainable growth are absent. When the shift from expansion to deflation occurs, it will likely be sudden, violent, and deeply painful for investors who have allowed enthusiasm to override prudence. The greatest lesson from the AI bubble may be that even in an era of instant global communication, when warnings from experienced investors are available, when fundamental financial metrics can be instantly calculated, and when knowledge of bubble patterns is widespread, human psychology still drives collective irrationality. The danger is not that AI fails, but that our expectations for near-term returns on the enormous capital being deployed prove impossible to achieve, rendering the bubble inevitable and devastating.